Go. Perfect. Well, Mac, I appreciate you joining the call today. We have the topic of the golden handcuffs. So the thought behind this is we have a lot of rate lock sellers that are giving pushback to the next phase of their life, and so the idea here is to turn those, sellers that are kind of on the fence into move up or downsize buyers. So,
Okay.
I think a lot of people think that the sellers are stuck, and I disagree. I think that they just feel that they're stuck, right?
Right.
So a whole segment of homeowners are locked in at 3 or 4%, and they just don't want to list because in their mind, moving means giving up that interest rate, and that's the golden handcuffs. As an agent and myself as a lender, our job is not to argue with the rate because they're correct. They have a very advantageous interest rate, but it's to widen the
Right.
lens on everything else that they have that works in their favor. From what they lose to what they gain. So, the old frame of mind is I can't move, I'll lose my 3% interest rate. Well, the new frame is what can my equity, my next home, and my cash flow do for me right now? And that's really the correct lens. I think going to the point of this slide here, a low rate typically means high equity. If they have a low rate, they've at least owned the home since COVID, right? And we
Right.
all know that in that couple year period, 2020, 2021, 2022, I mean, most MSA saw appreciation in double digits each year. So for some very lucky few, they might have seen 30, 40% appreciation. For others, it might have been 10 to 20. But regardless, they have a lot of equity by this point in 2026. And, they've been paying principal, they've got the appreciation. And with that, that's a whole unlocked treasure chest of options because they do have money in those homes. So every locked in seller has a move. It's either they can move up or they can move down. Downsizing is not as common as it used to be, mainly just because the cost of housing has gone up so much. But a lot of people want smaller homes at a later stage in life, or just smaller homes because they realize they didn't need the 3,000 square foot house altogether. But more, young buyers, 20s, 30s, lower 40s are doing move up purchasing. They've got kids. Maybe it's singular, maybe it's plural. Maybe they want to be in a specific neighborhood with the right, lifestyle for them and their family. And so they're looking for maybe more space, more yard, something. And they're wanting to get out of maybe that townhome that they bought during COVID that they've got a
Right.
lot of equity in. A higher rate on a better life. So I made this slide because I just feel like when everyone says, well, I can't leave my townhome or my house because my rate's just so low. I mean, there's a lot of reasons why, in a non-monetary way, you can value, the move, right? You can value justification for, paying a little bit more potentially. Room to grow is a big one. For those move up buyers, they just may not have the capacity or they may not like the stair setup, like especially for townhomes, to have young kids and infants. So a bigger home fits the family. Maybe they work from home now because times have changed, and that's just the norm for them, and they might need some extra bedrooms to convert into offices. Um, it's you're buying the life, not necessarily the rate, right? The life is what that home provides, what it can provide. The rate will go up and down throughout the years. Maybe one day there's an opportunity to get closer to what they had previously, but there's a value you can add to the experience and the benefits of moving to a home that suits your needs better. Today's price is the lowest, and it will be as long as the values keep rising. Waiting for a lower rate, I've seen a lot of clients say, I'm waiting for lower rates. Well, that sidelines you, and that means you're missing out on appreciation. The homes are consistently going up in cost. Even with the high rate market we've had the last 3 to 4 years, the homes are still increasing in value, and so
Right.
that makes it harder to do that next move up purchase because even if you save on the interest, your down payment's going up, your closing cost is going up, and you're not capitalizing on that appreciation hedge you purchased at the time when you were first looking into homes. Now, equity covers a large down payment when you sell a home and use that money to buy into the next. So a higher rate only applies to the part they actually finance. So if they're able to put a sizable down payment, the numbers could be relatively close to what they were paying previously. And a lot of sellers
Right.
don't really know that. They just assume, okay, well, my payment's this, it's going to go balloon if I take this interest rate, so I don't even want to start the process. Down payments and equity unlock the ability for us to kind of play with that. And I have some live examples of that coming up.
So are you,
Less,
just a second. Are you showing slides? Are you sharing your screen?
yeah, it's been sharing the screen. Is it not showing on your side?
Well, it's probably my settings. I don't
Here, let
know
me
because
let me share again.
I'm looking at me.
It should be sharing
Okay.
right now.
All right, that's good. I see it now.
Okay.
Okay.
My recording might be screwed up. It may not have shared the first part of it, but that's okay. So we're gonna position the downsides. So less house, more freedom. Unlocking the equity from a home. If you're downsizing, there's a substantial amount of equity in your house, typically speaking, right? Most downsizers are middle aged. So these are homes that they've had for 10, 20, maybe even 30 years. Maybe it's even fully paid off. Who knows, right? But selling the family house turns years of equity into cash, right? And so that allows them, when they do downsize, to put either a full cash offer on the table to buy a home of smaller stature, or it allows them to take a very small loan, right? And so a very
Right.
small loan means very low payments, keeps within budget. Of course, having a smaller house means less upkeep, lower taxes, utility cost goes down, you name it. It's a benefit to those downsizers. But the equity that they have from their current home gives them a strong buying position for the next. And I think, again, going on the rate topic, a lot of downsizers they get locked into the idea of the rates, the rates, but it really doesn't matter if you're putting 60, 70, 80% down payment, or even 100, because there's no rate at 100%. You've paid it in cash,
Right.
there's no loan. But having a small loan of 100, 200,000, you'd be surprised how little the difference is of 1 to 2% between interest rates. It's not a substantial amount of money difference. So the downsizers, those are a little bit easier conversations because we can very clearly on screen strategize with them and help them
Right.
understand what that looks like, in the various scenarios of how much they would put down at different price points, etc. So they can see, what, Ian, you're right. It's not that big of a difference. Now, strategy one, put the equity to work as a big down payment. So I just mentioned that as part of the downside strategy. So large down payment from a sale shrinks the new loan, which softens the blow of the higher rate. The bigger the down payment, the smaller the balance that new rate is charged on. So in this particular example on screen, I have equity from a sale of 220, new home price is 600,000. We apply 180 as down payment. We're now only financing, 420. So if you think about 600 versus 420, that's a huge difference. And so that rate will not make as much impact, now that we see a lower loan amount than, the purchase price, the sticker price of the home. Trade high interest debt for a stronger balance sheet. So strategy two is, by default, or not default, but by selling a current home that has a lot of equity, we might be able to pay off some credit, some debt, long-term debt with high rates that they may have that will help with, making their financial picture even better. Their loan may have a higher interest rate, but we may be able to put them in a situation where they're either better or close to where they're already at with monthly expenses by paying off some of this debt. And paying off high interest debt is big because that can balloon, especially credit cards. It can just keep building, building, building to the point where you can't get
Yep.
out from underneath it. So one of the strategies that I implement a lot, and I actually have a better example on the next screen, is educating clients. Hey, do you have some auto loans? Do you have credit cards that you maintain balances on? If so, let's look at that and see what the cash flow difference really is when you factor everything together. So, 61% of U.S. households are paying off a car loan. 48% are paying off, or I'm sorry, they're not paying the full balance of their credit cards month to month. So in this particular example, they've got 35,000 in high interest debt to pay off. The $850 a month in debts erased. Their payment on their mortgage in this example goes up $600. They're technically better in this little example, but a more real world, run through the numbers is this. We've got a client that bought a home for $350 in 2021 at 3.25 rate. That home is now worth $550. They've got 45,000 in car loans at $900 a month combined and $10,000 in credit cards at a $300 a month payment minimum. They want to move up to buy a $600,000 home. So let's look at this. If they sell their home, let's just say they get 267 in net proceeds. They pay off all of their debt, which is 55,000, and they've got 212 remaining to go towards the down payment of their 600,000 home. That puts their loan amount at 388. Now at 625, their principal and interest, or 6.625, sorry, their interest or their principal and interest is 2,484. They were paying 1,219. I'm not disputing that the mortgage is more expensive, but they also are paying an additional $1,200 a month on those debts. So that put their all in at 2,419. And remember, that debt picture was with minimum payments, right? So that's not factoring in paying down their balances, etc. So at 2419, we now go with the move up purchase to 2,484, which is more or less the same on the grand scheme of it, right? And we put them in a better position financially because they no longer have debt that can continue building. They've got two paid off cars. They are able to kind of go through life on almost like a reset button and get a bigger or better location for their home. So, when it comes to kind of talking about, these strategies with clients, it's important to understand their total picture, not just their interest rate, because the total picture can tell a very different story about what their numbers will look like versus if you just compare the mortgages by itself. Strategy 3, as part of, unlocking, equity and having money to throw at a transaction, it's something that we've already talked about. We've got buy downs, we can utilize, seller paid buy downs, permanent buy downs that the buyers pay for, use seller credits to help, make the next purchase, make the home more affordable. There's a lot of different strategies, that, they may not be thinking about that we have to remember to share with them because there's options on the table. Now, the timing play. Buy first, sell later, then recast. I cannot tell you, Mac, how many people do not know about recasting. It's actually kind of funny because it's like one of the best tools in the business. A lot of sellers are afraid of the logistics, right? They're like, well, probably can't time my sell and my purchase at the same time. So this provides a huge level of stress for them because then they're like, well, I can't go under contract until my home sells. But what if there's not a property for me or I don't love what's out there? If the client can qualify, they can buy their next home first. They can go ahead once they're in a contract, list their current home. And then once that home sells, we can recast their mortgage from their purchase with the equity that they then took from the sale of their home. So for most clients, the strategy that I do in this particular case is we do a minimum down payment loan, right? Because they probably don't have a lot of assets, or we let them borrow from their retirement accounts on a temporary basis to put a large down payment that they then pay themselves back on. But regardless, it's usually the smaller the down payments. We get them into the home, their home sells, and then after they've made their first mortgage payment, they can then do the principal reduction on their current loan with the new house that they bought and recast that. And what recast essentially means is, let's just say they had borrowed $400,000, but then after their home sold, they were able to put $200,000 into the principal reduction. It's now a $200,000 loan. A recast allows the payments to be redone on their monthly requirements from the $400,000 loan that they closed with to now the new balance of $200,000. So this can greatly reduce their overall costs also greatly reduces the amount of interest that they're going to pay over the life of the loan. And it doesn't cost anything like a refinance would. Like a refinance is going to have closing costs. There's attorneys involved. There's, appraisers potentially. There's various credit reports, etc. So this is the way to do it essentially for free, as far as cost is concerned, to reduce their overall payments. And, I cannot tell you how many people don't know about this. So the long game, 4% a year rewards the biggest assets. So at a long run average of about 4% a year, appreciation compounds on full value of the home. Own a larger, more expensive home, and those same percentage gains land on a bigger number. So moving up can build more equity than sitting still. So think back to that example of the townhomes that I mentioned. A lot of people bought townhomes in 2020, 2021. They're probably they're probably not seeing that 4% appreciation year over year anymore on that asset. It's probably a little bit more conservative just because it's a townhome and etc. Um, Moving out of that and then buying into a bigger, more expensive house and maybe a neighborhood that's continuing to grow, you're going to see a better ROI as far as appreciation goes. And the more expensive the home, the better the numbers look. So, you have a $400,000 home, and on this example, it goes up. It's kind of blurry on my screen. I don't know why it's blurry. Um, I can't read it, but it goes up in this particular example to 488, I think. But if you started at 600,000, it goes to 729, and then to 835. So you go from a $600,000 asset to 835 asset over here. But on this particular case, on the $400,000 one, it goes to 592. So the more home you buy, the more expensive home, the more you're going to receive in terms of equity appreciation. This is not me advertising to only buy expensive homes, but naturally, if you're on the fence about, being stuck in your current lien, this net worth increase can definitely be a reason for why you should.
Now, I had a question before on the recast. How does the
Yeah,
qualification process for that work?
there's no
I mean, if you're
qualification.
so
It's literally you have a bunch of money and you want to throw it at the principal reduction, you do that, and then you can recast your loan once a year.
okay, but the new loan for the new house, while you still own the old house, is a normal qualification.
Correct. Yeah,
So
so
you'd
they would
have
have
to,
to they'd have to qualify for both, or we'd have to do a bridge loan. So that's the two
right,
options.
right,
A lot of clients can qualify for both, but not every client can. And for the clients that cannot, we will talk about bridge loan options, things of that nature, to help get them into the home next for sure. The bridge loan comes with additional steps because those are meant to be temporary. So the recast is not necessarily, the strategy with that. It's more of a refinance to get out of the
right,
bridge loan. So ideally, we always try to qualify hitting them with both expenses because it's going to be the best for their balance sheet. Less cost,
right.
less logistics, less everything.
Okay.
Yeah. So one move, several wins. So using the equity as down payment, using it to help pay off debt, use it to reduce the interest rate, and maybe if you're buying a bigger home, seeing more appreciation ROI. Getting out of that home with the lower rate may seem like the most daunting thing ever. It may seem like a stupid financial decision. But in many cases, it can be a blessing. It can be a huge financial win. It just may not appear that way if you look at a specific mortgage calculator. But there's a ton of different ways that it can improve a client's life. It can improve their standard of living. It can improve their future net worth, right? As I use that townhome example, if they buy a single family home today, and from 400 to 600,000, they're going to see much more net worth increase over the 10, 20 years than they would if they just continued to pay for that townhome. And so there's a million reasons for why. We just have to show our clients these things. So this is the whole market This is not a niche play. The clear majority of home sales are people who already own or are trading up or trading down. We have rate lock sellers, but they can, there's obviously people out there that are, listening to this. There's people out there that realize, that it doesn't make sense to continue sitting on the sidelines. You may have a perfect home and you don't need to move up or downsize. That's fine. That may not, new home may not be for you, but there's plenty of clients that are not happy in their homes that they bought, right? They're ready for something different. They're ready for a new location. They're ready for something. And there's 4 million existing home sales across the country every year. 79% of buyers already own a home and they're repeat buyers. There's 3 million move up and downsize moves that happen every year. There's a lot of people that fit today's topic. And so it's our job to figure out who they are, what their whys are. If they were entertaining a move, what's the reason? Is it just to see a different tree? Or is it to put their kids in a better school? Is it to be closer to mom and dad? Like, what is the why behind why they want to move? Because when we understand that, we can get into, we can dig deeper and find out more things that can kind of maybe make that make sense for them. So your takeaways to go back to your sellers. The rate is one number. The equity, the appreciation, and the cash flow will tell the real story. Cash flow includes their entire balance sheet, not just the principal and interest comparison. A low rate usually means high equity. So if we know a client has a low rate, then we know, ding, 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 they have a lot of equity in their home. And equity is a tool that we can use as our friend. A big down payment from a sale shrinks the new loan and softens the higher rate blow. Rolling high interest debt into the move can make their monthly payments better or similar to what they're already paying. And that's my job to help educate them on as the finance guy. Buydowns and recasts can also bring the rate and payment back to where they need it to be to stick within their budget. And, move up or downside is what most of the market's already doing already. They just don't think that it's wise because they're looking at a mortgage calculator. So there's a million reasons why, and we just have to help them see it. So, Mac, I appreciate you jumping on today. If you have any sellers that are on the fence, that need just to see the numbers, part of my pitch has always been to agents. It's like, I love to do planning. I love to do strategy. It's like one of my favorite things. And so when I, get introduced to a client that may be in a situation like this where they're maybe on the fence of buying or selling, I put their current numbers. I ask about their current debts. We look at what maybe a net proceeds sheet would look like, and we play with it. And we do it together. And I do it on Zoom, just like I'm doing this, so they can kind of see the differences in the numbers and see what makes sense for them. It may be equal, it may not be. But at the end of the day, the why behind it may help them get past, if it's unequal, whatever that hurdle may be and what that delta may be. So I appreciate you jumping on. Is there any questions that you have? You're on mute.
Yeah, no, no, not really. I understand what you're saying. I don't have any sellers right now, although I'd love to. They'd be much easier than buyers, I think.
Yeah. Well, seller's market, buyer's market, it just kind of depends, right? Some sellers are hard, and getting the number that sellers want for their house is not always the easiest. Sellers have big
Yeah,
aspirations.
right.
I think there's pluses and minuses to both markets, but getting business as a whole is the name of the game. So if you do have any
Yep.
sellers that come across your desk and they seem tentative or hesitant, you know, ask them why they're tentative or hesitant. If it's about the numbers, about the rates, that's a tap in for me to help, walk them through, what those figures could look like so they can do better than just saying no, right? No without
Right.
evidence, no because I think it's going to be more expensive versus the actual reality.
Right.
Yeah. So cool. Well, listen, I hope you have a great rest of your week, Mac. Again, appreciate you being on the last couple of weeks' calls. If you have a topic that you'd like me to put out, I haven't decided what my topic for next week's going to be. So feel free to message me if you've got something that you'd like me to put into this, because Every week I try to come up with something unique or, maybe not unique, but relevant. And so if there's something that's relevant to you, it's relevant to me.
Okay. All right. Sounds good.
Perfect. You
Thank
have a great rest of your day, okay?
you too. All right.
All right.
Bye-bye.
Bye bye.